Episode 180 of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everyone, before we get started today, I want to thank our sponsors. CME Group, Trading Technologies, RJO Futures, and Top Step Trader. Now today I spoke with Mark Dow, founder of Dow Global Advisors and Behavioural Macro blog. Today I began the conversation by asking Mark his backstory and how he got started in financial markets. We discussed his blog, Behavioural Macro, and why he started to write. Next, we talked about the Fed and bubbles. We discussed how interest rates and the risk cycle will impact the stock market. We chatted about central banks and yield curves. Then Mark tells us what he thinks about gold and cryptocurrencies. Finally, we discussed emerging markets, commodities, and currencies. As usual, thank you all for listening, and please enjoy this episode. Mark, welcome to the show.
Thank you. Thank you for having me, Anthony.
It's great to have you, Mark. I started my pursuit of having you on the show about 2 years ago. You're one of my first follows on Twitter, so I'm very excited to speak with you today. But before we begin and go over all of the great topics we have to talk about, tell us how you got your start in the industry.
Okay. Well, for me, I never really planned to get into finance. I was interested in economics, international economics. Went to graduate school. And I got a job out of graduate school at the Treasury Department, and I ended up working on emerging markets and a lot of sovereign debt situations, the crises in the 90s. I worked at the International Monetary Fund for some time. And then I realized that to be more complete as an economist, I needed to see how markets worked. I needed to understand them better. And I got a job offer as a sovereign analyst at a mutual fund company in Boston. And I went there. And before I knew it, I was portfolio manager at a mutual fund, managing emerging markets debt. And I got involved in other asset classes over the years there. And then I wanted to take on the ultimate challenge, which was trading at a global macro hedge fund. And I did that for about 7 years in New York at Farrell. And now I run, basically it's a glorified family office here in Southern California.
Well, take us back to the moment that you knew you wanted to be in financial markets. I know you went through the college and everything, all the education to get to that point, but I'm curious, what was the drive behind you to get into this industry?
I didn't have the drive, to be honest. I was always disdainful of business and MBAs and things. I didn't think it wasn't interesting to me. I was much more interested in economic policy, so I worked on that. And then when I was in the middle of all these sovereign debt workouts in the 90s at the Treasury Department, I had to learn a lot of finance along the way as we restructured these countries' balance sheets, basically. And I saw that was interesting. And then it also became clear to me in my time at the IMF that increasingly markets were financing emerging markets and governments were financing them less. Up until that point, governments were the primary financiers of emerging markets. So the United States would guarantee a credit to Brazil so that they could buy American planes, that kind of thing. The market was slowly taking over these functions, and the market was increasingly the locus of activity. So I said, to understand emerging markets better, I need to work in the markets, and having had this background in emerging market finance, it was kind of an easy transition. At least intellectually an easy transition. Learning how to manage risk, of course, was difficult and took a lot of time. It's a very different thinking how the fundamentals work to actually applying these things in markets in a way that where you're trying to make money.
Now, you said that you're running basically a glorified family office, but you also have an excellent blog called Behavioural Macro, and then you have that private Twitter feed as well. Talk to us a little bit about that.
Yeah, so I've been on Twitter for a while. I mean, before I left the hedge fund, I started tweeting, and I enjoyed it. I just thought there were a lot of things out there that people weren't really seeing. They didn't have the inside experience, both with respect to international economic policy and with respect to risk taking. The nitty gritty of risk taking in the markets, which can be very divorced from fundamentals at many points in time. So I thought I could share these things and have some fun while I was doing it. And then as the number of followers kind of grew, there was more noise on my stream. And I thought, and I was getting a lot of requests from young guys in particular. They're either new to macro or wanted to get up the curve faster, asking me, suggest this. What do you think of this? On all kinds of platforms, I was getting bombarded. So I said, you know what? I should start a little Twitter thing where I ask for a small fee to kind of cream off the riffraff and link it to a blog so that I can teach, explain, share my experiences with all these guys on one platform. And I set it up, and so I run that now, and it's kind of fun. We have good conversations back and forth, really breaking down how to structure risk around a particular trade idea, or something as abstract as how to look at central banking in the modern age. So it runs the whole spectrum. But it's a neat experiment, and I'm having some fun with it.
Very cool.
The Twitter, by the way, is called Behavioural Macro. My Twitter is Mark_Dow, and then the sub Twitter account is called Behavioural Macro, and that's also the name of the blog.
Question about your primary Twitter account, the Mark Dow account. Why the monkey with the machine gun?
Well, I just kept it. I started because I was always trying to explain to my colleagues that it was less about fundamentals and more about risk management. And I said, a monkey could do it, but you have to be an aggressive monkey, because one of the things when you take risk, you have to be aggressive, right? You have to know when to be aggressive and when to lay off. There are a lot of guys that are pretty good at reading patterns and understanding market rhythms, but they often don't take enough risk when it's time to take risk, right? The first level is learning not to take bad risk, huge risk at the wrong time. I think a lot of guys, and how to stop out of positions. I think a lot of guys learn that fairly quickly. But the next level is how to hold on to winners and how to be aggressive when you think you're seeing the ball well. So I joked you have to, a monkey could do it as long as he were an aggressive monkey. And I found this I found this image on the internet of a monkey with a machine gun. And so I just put it in there, and I tried changing it once, and Twitter almost exploded, it seemed. So I said, I'll stick with the monkey with the machine gun, and that's really it.
I want to talk about something that you just said before we get into one of your tweets, and you talked about knowing when to put risk on, and it's amazing to me how I could listen to someone like you who's global macro all the time versus someone like me who's a day trader. And I've always said know when to trade big, know when to trade small, know when not to trade, and you make money in moments in this industry. You don't make money by coming in and making the same amount of money every day, every week, every month. It just doesn't work that way. At least for me, it hasn't. The times I've really known I was right because all the stars lined up is when I've learned to really pound it, because that's when I could really make enough money to survive during the times where my other ideas aren't working, and just to manage risk. So it was really cool to hear you say that. Now, I want to talk about one of your latest tweets. And you said, if you see someone saying printing money did cause huge inflation, but it was asset inflation, you can safely disregard all of their macro analysis. I started laughing out loud when I read this because I'm like, that's me. I put a tweet out there saying that, the Fed has found a way to create inflation, and I put a picture of the S&P 500 chart. So then I went to your blog, and then I started to read because I'm like, okay, obviously Mark knows a lot more about macro than I do. I don't claim to know anything. It's just what was one of the things that I have noticed. The Fed started QE, and printing money, and stock market has gone up. You can't kind of disregard that correlation. So I just once again, as a non-macro guy, I said that. So are we wrong, Mark? Explain to us why we are wrong in thinking that the Fed has created asset bubbles in stocks, and in some areas I think they've created real estate bubbles too.
Yeah. Okay. So one parenthesis before we get there, I want to say about the risk management stuff we were talking about just a second ago. I manage in two styles. I have a trading style and an investment style, and it's in the trading style where you really like as you were saying, you really have to push it when you're seeing it because you make money in batches, and the longer your investment horizon, the more you're relying on your hit ratio and the less you're relying on strict risk management frameworks. But I wanted to say, we can come back to that later if you like, but I wanted to be clear on that. Now, when it comes to the Fed and bubbles, I think it's really kind of counterintuitive for a lot of people, but I think that people confuse liquidity with credit. The Fed, people think the Fed has been pumping all this money into the stock market, but the money doesn't go into the stock market. It's in excess reserves, and there's a reason we call them excess. They're not being used. They're not needed, right? So the Fed basically lowered interest rates as much as it could because we had a big credit bubble, and obviously after a big credit bubble, you need low interest rates so that people can work through their households and financial entities and everybody. We can work our way through the debt burden that we built up for ourselves, right? It just takes a while to come back from that when it's an overhang. So when they lowered rates, it wasn't enough. So they decided, well, let's push low end rates down further by buying bonds, and this was what they eventually was called quantitative easing. But functionally, what it really did was, it was like the old days when the bankers would stack money in the windows to show the depositors that they were solvent, right? To quell the runs on the bank, they would stack money in the window. I don't know if you've ever heard those old stories, but that's what the Fed was basically doing. It was a big confidence shot. The money didn't go anywhere, but by injecting all this liquidity into the reserve system, not into the economy, not into the markets, but into the reserve system, right? It gave everybody confidence that, hey, okay, we're not going to have a banking crisis, and it was a way to short circuit the negative spiral that sentiment was in at that time. So the banks don't lend anymore the way they used to. They lend based on collateral. So what creates credit is not how much base money the Fed is pumping into into reserves, right? It's really about credit and the banks extending credit and people taking credit from banks. And that has very little to do with the Fed directly. It has to do with risk appetite, right? So this is why we didn't have rates were at zero forever, and we didn't have loan growth. It wasn't about the price of money. It's because people were still scared. And it's for the same reason we had rates at 5.25% in 2005 and 2006, but people were borrowing like crazy. Why? Because when you think you're going to make 200% over the next 5 years, 3% and 6% looks like the same number to you. You just don't care. So people have this idea that the Fed is, and these are typically guys who don't understand the mechanics of monetary policy well. Fed puts this money in there to kind of calm the system down, to make sure that all the banks are going to have resources with which to meet their obligations to each other in the reserve system, right? But the banks were just selling their bonds and now they're holding cash. It's not a big deal. They may go replace it with other bonds. They may not, but they're probably not going to go out and buy a bunch of stocks with it, right? Because banks don't have that mandate to buy a bunch of stocks. So people have this idea that when the Fed, it's all fungible and it has to go somewhere. Those ideas are wrong. The reserves in the Fed system, it's a closed system. That money doesn't leave unless the banks demand physical currency, unless a lot more physical currency, which typically doesn't happen. So it's kind of just a misconception that people have about how this thing works. Base money is a small share of the overall money supply. And whether the Fed is making it expand or contract, it has a signaling effect. It has a psychological effect, but that money doesn't really get into anywhere. So the way you want to look at it is the Fed injected all this money, short-circuited the negative spiral, people calmed down, and little by little started taking risk again. And as they took risk, and the risk didn't come from the Fed's money, the Fed came from the money that we had put on the sidelines when we sold out in the panic, right? It was us putting the money back in. It doesn't come from the Fed. Now, the two paths are going to look like they coincide, right? Because the Fed is trying to ease financial conditions as the market is recovering, right? But we've seen over the past couple of years that the Fed has stopped increasing. The last few years, Fed has stopped increasing their balance sheet. They've increased rates significantly, a fair amount, and no problem. Now everyone says, well, in Bangladesh they're printing money and it's all fungible, or Japan or Europe or whatever, and it has a little bit of an effect on our long-term yields. But that money's not coming into the stock market either. It's giving people confidence. So, like I said, you can look at times in history. We've had, the bubble in the dot-com bubble. It happened at very high interest rates. Remember the S&L crisis? You're probably too young, but you probably heard about it. The S&L crisis was overlending. It happened at much higher rates. So I think the two, if I could boil down the two things that people continuously get wrong, is thinking that the Fed base money is dominant and influence and drives the money supply is one. It's not. It's a small share of the money supply. The bulk of the money supply is decided by whether a bank wants to run at 3 times leverage or 10 times leverage, right? And that's really it. And then the second misconception that people have is it's all about the price of money. It's not about the price of money matters, but it matters a lot less than people think. And as I said, people in 2006 that was the most aggressive year of borrowing in the housing crisis, and Fed funds was at 5.25%, right? Why? Because they were greedy. Greed trumps the price of money. Obviously, it's different if you're talking about 15 or 20% interest rates, but interest rates within a reasonable range matter much, much less than people's risk appetite. Do they feel secure in their job? Do they see people around them making money? The banks are looking around. Do we have to compete with other people? These are the factors that push people to take risk much more than the price of money. And then the Fed's role in the overall money supply is much, much smaller than people believe.
So if the Fed continues to tighten, you're telling me that you don't believe that is going to have a negative effect on the stock market?
Well, it will. It depends. Removing QE will not, because if you bring 100 tacos to a party with 5 guys, and then you say I'm going to take 50 away, the guys are still well fed, right? There were just too many. So the QE is being taken away. We didn't need it. We got the psychological benefits from it. It calmed people down and helped us rebuild our balance sheets and get back up on our feet, right? It's a little bit like when you start, starting somebody's heart up again, right? Once or jump starting a car. Once you jump start the car, it can run on its own. QE kind of did that. Obviously, interest rates at some point will play a role, but I would argue that at least as important as interest rates is what the interest rates are saying about where we are in the cycle. So we know the cycle is going to end at some point, and I have some ideas on that are probably different from most, but it's going to end at some point, and we're going to have a bear market. And at that point, the Fed will be at maximum tightening mode, whether that's going to be at a policy rates of 3 or 2.5. We don't know that, but so it's going to coincide. The Fed easing for the next cycle is going to coincide with the bear market, so it can look like the interest rate provoked it. But what really happens, Anthony, is in these risk cycles, we get to a point where we're just so optimistic, and not just in financial markets, but also in the real economy, where we've invested aggressively, we've hired aggressively, we're out over our skis, we just couldn't be more optimistic about the future, and something happens that makes us question our optimism. And now, if you're questioning your optimism before you've hired people or before you've gotten out over your skis with investment, it's not a big deal. You don't have to dial anything back. But if you've overhired or overinvested, you do have to dial back, and that has a feedback effect onto the economy, right? So I think it's less about the interest rates provoking it. It's about what the interest rates are saying about where we are in the optimism cycle, between extreme fear and extreme greed. That's really what these cycles are about. Recognizing the process when you get out to the other end of the pendular swing, and there's not much room to get more optimistic. That's when you start getting vulnerable to a recession. It's less about interest rates. Like I said, if you're at 10%, it's a different story. But all of these rates we're talking about here are pretty low in an historical context. So yeah, technically you raise rates. It's not good for multiples. It's not good for the stock market. But if the economy's still going fine and people are optimistic, it won't matter. And then one day they will wake up and it will matter. So again, I think the Fed rates are almost a symptom of where we are in the cycle more than they are a driver of where we are in the cycle. At least that's my opinion in today's world. The monetary system used to be very different 30 years ago because it was more regulated and deposits were controlled. It was a very different world. So the Fed had much more control over the broader money supply. Now their control is very, very indirect. And we saw this, Fed was raising rates from 2004 fairly aggressively, and people didn't care. They kept borrowing until everyone got too extended, and then the party ended. So I just don't think we're as sensitive to interest rates. We're sensitive to them, but we're not nearly as sensitive to them as we've been programmed to believe, because we all studied economics at some point, right? And a lot of the stuff they told us was predicated on efficient markets, and markets aren't efficient. Humans aren't efficient. We have behavioral biases. We do crazy things, right? This is how we create bubbles and panics, right? That's just what we do. So I'm not so worried about the Fed causing the next recession. It will happen probably when everyone gets too excited and too optimistic and too out over their skis. And to be honest, I don't think that's going to happen for a long, long time. My guess is we're going to go through a period over the next few years of these soft patches in the economy that don't really constitute a recession, but just a little bit of a slowdown, and then we pick up again. It's probably going to go on for a long time because what we had was so catastrophic for so many people, and the psychological scars are so deep. You're not going to find financial institutions taking that kind of risk, 33 times leveraged or whatever. It's just not going to happen for a long time. And if the main transmission mechanism of panic is the financial intermediaries, and if those guys aren't highly levered, then the system is a lot less risky. People focus a lot on levels of debt. You see all these scary things about how much debt there is, but debt is important, but the distribution of debt is more important. It's much more dangerous for the households, for the economy, for the households to be heavily indebted than it is for the government, right? Because consumption is 73% of GDP, right? The government is only 20%. It's a smaller amount. And governments can kind of finance themselves under very adverse conditions, as we saw in the crisis. Homeowners can't, households can't. So that's an important point. It's much more dangerous when financial institutions are heavily levered than it is industrial companies. Why? Because industrial companies don't intermediate the growth and the consumption of the entire economy. So the fact that the debt has been redistributed in a way that's a lot less dangerous kind of suggests to me that we're going to have these periods where we get excited about growth, and then it slows down a little bit, no recession, and then it picks up again and goes, and that will probably continue for some time. I reckon. So, and the Fed rates aren't probably going to get all that high either, because our underlying growth potential isn't super strong.
So basically what you're saying is that if rates were to go up too quickly, then that could have a negative effect sooner on the stock market. But if rates slowly go up, where it's just a matter of when the risk cycle hits the point to when that will just coincide with the fact that rates have been going up, and that's when we actually see the negative impact on the stock market.
Right. Basically, yes. Anything, we are much more scared of speed than we are of levels, even though some levels matter, right? I mean, you know this from your trading.
Yes.
So if something happens fast, then we can get a sell-off. But my guess is if things go slowly, we'll continue more or less as we have, because the cost of capital is just not going to go that, even if it's 100 basis points higher from where we are, or 150, it's still not that high in the grand scheme of things. And of course, as economies improve, what do central banks do? They tend to tighten from the excessively, or the very easy conditions that were present before. They need to tighten. So they're going to be tightening as the economy strengthens. So of course they're going to be correlated. When you get to the top of the economy, the Fed will have been raising rates by definition. I mean, you want it that way. So historically, the Fed has been much more a driver of the cycle because its impact on monetary policy was much more direct. Not only for the regulatory reasons I mentioned earlier, the way monetary policy was conducted, but also the internationalization of monetary policy. Money flies around the world with much greater ease. And so we have a greater impact on others, and others have a greater impact on us.
And I look at it from a trader's perspective. It would be just too easy for the Fed to raise rates a little bit and all of a sudden the stock market just turns down. It would just be the easiest trade of all time, right? Because I know that I was anticipating when rates were starting to go up, the stock market at some point was going to turn over, and the exact opposite happened. So once again, the weak hands got turned out. But I want to know a little bit of what you think about what the Fed has done. Let's just go back. It's 2018. Since 2008, we've been 10 years since probably one of the busiest years that I've ever traded in my career, 2008. And also, what do you think about the newly appointed Fed Chair, Jerome Powell?
Okay, so I think the Fed has done a fantastic job. Monetary policy is not as powerful as its critics feared, and it's not as powerful as its greatest supporters alleged, right? And that's just because we had a big debt overhang. So monetary policy is not going to be, people are not going to be that price sensitive when they're retrenching. But the Fed did critically step in and keep us from having to line up in front of ATM machines in the middle of the night hoping there was still money in there, right? We were that close. I remember in 2008 myself being at the heart of the international fixed income system. And I saw that banks weren't facing each other. They weren't trusting each other, that money had to go through the Fed to go from Goldman Sachs to Merrill Lynch, that they would. And so basically the system had already broken down. And had the Fed not jumped in with all those credit facilities and what people called QE1, but really was credit easing. They were trying to fix the pipes. They said the plumbing is broken. We need to fix these pipes. And then once we fix them, we'll worry about more money running through them. And I think they did a beautiful job in that. That plus the stress test that Geithner ran out of the Treasury gave people confidence in the banking system, and it allowed the private sector to issue, the banks to issue massive amounts of equity to recapitalize. Right, so it wasn't on the government, and the government got paid back and made money on TARP. So it was a good thing all the way around. They short-circuited the panic. They recapitalized the banks not on the taxpayers' dime. And the system healed. We saw the countries, Europe wasn't nearly as aggressive, and they languished for much longer, right? So I think they did a really good job. I was pretty relaxed during the whole time because I didn't think it was going to cause inflation, because no one's going to be lending or borrowing for quite some time when you're coming out of a credit bubble. So, and I knew that the reserves that they were quote unquote printing were excess, and they weren't going to go anywhere, right? So they weren't going to go into asset prices, and they weren't going to go into goods prices, and we weren't going to see all these dire predictions. But a lot of the monetarists were predicting V-shaped recoveries, and I knew that wasn't going to happen either, because like I said, if you have a credit overhang, no one's going to be borrowing or lending until they've healed. And healing is not just a matter of fixing your balance sheet, it's also psychologically healing. I know you know this from your trading, Anthony, that mental capital has to be preserved. If you're not in a strong position mentally, when it comes time to take risk, you're not going to get it right. Yep. Right. So it's the same kind of thing. What the Fed basically got us into a strong position mentally, and allowed us to work through our balance sheet problems. So I think it was great, and they were also pretty courageous in the face of a lot of criticism by people who didn't understand the Fed, that didn't understand monetary policy. If you remember, they were in 2008, oil prices went to 150. And people were saying this is because the Fed is printing money, all this other kind of stuff, and the Fed has to hike rates to stop oil. And that was wrong on a couple of counts. The Fed said this is transitory, and it was, and so they didn't hike. And second, they don't realize that the oil wasn't at 150 because the Fed's monetary policy stance. It was there because people were afraid that China was going to suck in all the oil from around the world, and there was never going to be any oil for anybody else ever again. They forget what that rally was about. Rates were relatively high. So in 2008, and then again in 2011, people were saying the Fed needed to hike because oil prices were high. The other error that this line of thinking, and it was really, really common, Anthony, I'm sure you remember it was dominant in the markets, is oil. People were anchoring on the late 70s and early 80s, and they said oil's going to bring us down. It brought us down in the past. It's not. It went from a share of 11% of your wallet to a 4% share of your wallet. The energy efficiency or the energy intensity of our GDP declined by more than 50% from 1980 until 2010, right? We just don't use as much. So it wasn't, if we don't use as much of it, the price going up or down is not going to hurt us nearly as much as it used to. But people had anchored on their experiences in the 80s and thought for sure it was going to bring us down. So these were the two mistakes that people were making. The Fed soldiered through, and people mocked them for saying transitory. And guess what? It was transitory, and the Fed was right, and markets were wrong. Fast forward to today. They've started their exit strategy. They were very clear about what they were going to do. And they laid out the path. We're going to follow the data until we get there. They did. They started the process. None of the bad things that were supposed to happen when they first tapered and when they raised rates and when they tapered to shrink the balance sheet, none of those things happened, and they're not going to happen. Powell is coming in. I think he'll be fine. He's a reasonable guy. The regulatory issues, he's not going to be dramatically different from his predecessor, but because his predecessor was already looking at it, their philosophy, and I think this is the right one, and I think if Geithner was still there at the Treasury, he'd say the same thing. It's been 10 years since the crisis. It's been 8 years since Dodd-Frank. Let's look at the whole set of regulations that they put on the books and see which ones are working, which ones aren't, because a lot of them aren't working. That's how it happens every single time, right? And Jerome Powell is very upfront about that. He was leading that effort for Janet Yellen, so now he's going to take it on himself. They don't want to recreate the lax conditions that we had that led up to the last credit bubble, but they don't want to unduly burden a lot of banks with regulations that aren't really helpful either. So I'm pretty optimistic that he's going to continue solid policies.
Let's talk a little bit about central banks. Right now, we're seeing a divergence from the Fed. And I think really this is a big reason why we are seeing a lot of action in the yield curves. What are your thoughts on the yield curves and the central banks outside of the U.S.?
Well, okay, so the first thing to say about that is that the other central banks are behind us. We've recovered sooner, largely because of the aggressive policies of starting with the Bush administration and then followed up by the Obama administration, Paulson and then Geithner, and then with the help of Bernanke. That put us on better footing. We recovered earlier, so naturally our central bank is starting to take its foot off the accelerator sooner, and these other central banks are getting to the point now where they can do that. Up until now, we've had very, very low yields at the long end, and part of it is because our central bank was buying. Other central banks were depressing interest rates at home, making U.S. Treasury bonds more attractive, and the share of people or entities that are buying treasuries. Let's say they're price insensitive buyers. So you have pension funds that have to hit a bogey. You have insurance companies that have to put premia to work. You have retired people who need demographic needs for the bonds. So there are the share of price insensitive buyers now in the treasury market is very, very large. The rule of thumb that people tend to use, the economists, they tend to say, okay, well, 10-year yields should roughly be equal to GDP growth plus inflation, so nominal GDP. And right now that would put us at around 4%, more or less. And the 10-year yield is way short of that. So you say, why? And I think the big point that people miss, they still think somehow that yields have to equilibrate the real economy, supply and demand in the real economy, demand for investment and all that kind of stuff. But really, increasingly, with so much financial creation over the past 30 years, right? The big global financialization that's taken place, it's equilibrating supply and demand, people needing to get invested, and assets into which they can be invested. And so there's a mismatch. And this is one of the reasons why bonds are lower. Now, in the case of foreign central banks, to the extent that they start to taper or they start to lessen their accommodation, right? Retract their accommodation, you're going to see people progressively be more interested in their home country bonds and less interested in buying U.S. Treasury bonds. The other thing that's making Treasury bonds less attractive to them is the funding rate is increasing. So, Anthony, if you rolled back the clock a year or so, when the Fed funds rate here was at 50 basis points or 25 basis points or very low, you could get a 10-year yield of 2.5%. You could buy that if you're in euros, right? And then swap it back to euros with a very low, very low interest rate on the dollars that you're shorting, right? So you're buying dollars in the form of your treasury, the treasury bond that you're holding, the 10-year treasury bond, but you're shorting dollars at the 1 month mark, right? So that you don't have an open currency, you're not taking a dollar bet, you're just picking up the carry. When that interest rate that you're shorting is 25 basis points, it's much more, your overall yield is much more attractive than when you're in the interest rate that you're shorting at the 1 month mark is 150 basis points. See what I'm saying? So you have a decline of that carry trade, the desire to put on that carry trade from the Europeans for two reasons. One, because their central banks are normalizing, and two, because we've raised the funding rate a considerable amount here in the U.S. So the effect over time should be we should see enough upward drift in our yields. The Fed doesn't hold many long-term bonds anymore. A lot of those things have rolled short, so it's not going to have that same kind of impact on, the reducing of the balance sheet is not going to have a big impact on the long end anyway. And I think it's just so small we're not even going to notice very much of it. But the permanent bid from insurance companies and pension funds and that kind of stuff, that's going to stay. That's not going to go anywhere. But the bid from Europe should lessen. And of course, our balance sheet rolling off will add a little bit of supply to it. So you would expect yields. It's global normalization. It's what is really what's happening, and that means yields are going to go a little bit higher, right? And from a currency standpoint, really what people miss, they think, oh, if interest rates in the U.S. are going higher, the dollar has to get stronger. We've seen that's not the case. We saw that wasn't the case in 2004 either when they raised rates. There was a brief blip in the dollar, and then from 2004 until 2007, the dollar just depreciated, and we were raising rates a lot, from 1% to 5%. So that's not really it. I think the way you have to look at currencies is which central bank are we focusing on normalizing now? So we've been focusing on the U.S., and the U.S. is closer to the end of its normalization phase than it is to the beginning. Japan and especially Europe are closer to the beginning of their normalization phases. So when we're focusing on them normalizing, it's likely that those are the currencies that will appreciate, and this is why the euro has been doing so well. The central bank baton, as it were, is being passed from the Fed to the ECB.
You mentioned to me that you are very active trading currencies and commodities, and you just spoke a lot about the dollar. And what was interesting to me about trading those commodities and currencies over the past year is the dollar has really been getting roughed up. And everyone I talk to on the commodity side, the soft commodity side, has been saying to me that really the dollar has just been having much less of an effect on us. It's much more about technology. And so I'm curious, someone who's so active in the commodities and currency space, what are you looking at right now? I know you have some pretty strong thoughts on gold, so maybe we'll start there and then mention any other commodities or currencies that you're eyeing right now.
Okay, cool. Well, I don't trade the softs too much because I do think that they're more determined by things like technology and weather, whereas your precious metals are determined really by market sentiment, primarily, rates and global macro stuff that are easy to discern because the underlying fundamentals aren't as powerful, right? It's really about speculation. And my strong views on gold are really long term. They don't always affect my trading, but it's the background. It's the background story. Just really quickly, I saw when it was a bubble in 2011, I started to short. I had to wait. I was waiting for a couple of years to get to short it because I knew that printing money, so to speak, the QE wasn't going to cause the inflation that people were betting on. If you remember, Einhorn and Seth Klarman and Soros and Druckenmiller and all the big hedge fund guys, right? They were buying gold. Paulson, they were buying gold because they misunderstood monetary policy too, right? And I just knew they did, and I had to wait to short it. And 2011 came the chance, and I've been shorting it pretty much ever since. Last year, in fact, my confession is it was the first year I didn't make money trading commodities since 2011. It's usually been my go-to, but my long-term view on gold is that the bubble phase is over. Now, global rates are going to creep higher as we normalize, and that tends to be bad for gold. So there's a cyclical reason not to like gold, and that's gonna persist. It's going to underperform other things. And then super long-term, there's secular reasons not to like gold. It's just being replaced. We don't have the gold standard anymore, and we're not going back to it. So a little bit like they say with science, science progresses one funeral at a time. And they say that because scientists never change their mind. They just die off, and the new scientists, obviously, they latch on to the better ideas, right? So the bad ideas slowly die off. Well, with gold, there are a lot of old people that think gold is still a good protection against systemic risk, though it's not. We saw what happened in 2008. Gold plummeted when the market plummeted. They think it's hedged against inflation. It doesn't seem to be the case. It's just not what it used to be, and then people will say, well, yes, we've had 4,000 years of gold. I'm going to stick with that. And I said, yeah, but we rode horses for 4,000 years too, until Mr. Ford came along, right? I mean, things change, and just the same way that fiat money disrupted gold, electronic payments are going to disrupting fiat, and gold is just going to move further and further with every passing day from the center of the monetary universe, and it's not going back. So I think it's just going to grind lower and become irrelevant. Maybe it will be 3 generations from now. Maybe it'll be 10 years. I don't know, but I think there's a secular story in addition to the secular one against gold. But for the trading, I have noticed that correlations to the dollar have declined, and not just between commodities and the dollar, but also bonds and the dollar, right? So the correlations have tended to be low. This happens when the risk cycles are fairly advanced anyway, right? One of the reasons why the VIX is so low is because we have sector rotation. People don't want to sell. They're just migrating from one sector to the next and back again. And this tends to dampen the overall levels of volatility in the market. So we're seeing the same thing in commodities and currencies. I'm aggressive in my trading accounts. With these, I'm not as aggressive in my investment accounts. And I look for technical setups that fit the story. So if people have been focusing on the U.S. Raising rates and the dollar has been bid, I look for signs that story is getting tired, and the correlation is starting to shift. And then maybe I'll close out my gold shorts, that kind of thing. That's kind of how I trade them. I use technical pattern recognition and things and technical analysis for entry points and exit points to get my asymmetric payoffs. And then I try and follow the narrative that the market is following to look for shifts, right? That's basically the way I play them.
As a trader, we always talk about execution is everything. I'm curious, how are you executing your short positions in gold?
I just trade the futures. That's it. I don't use GLD. I do trade the miners a lot because they never see, even when gold goes up, they seem to do poorly. So I short those periodically, but mostly I follow silver, gold, and platinum very closely, and I look for indicators, reversals. Like so, right now we're at a point where the dollar sold off for a while, and gold has had a nice run. The euro's had a nice run, oil's had a nice run, and I'm looking for signs. I don't know that it's going to reverse, but we're at a point where it could reverse. And I've seen a little bit of weakness in platinum, and platinum tends to lead the others. Silver's been trading weaker than gold. That's another sign that maybe we're going to roll over. So I just look for signs that we're going to roll over, and I look for asymmetric points to kind of get in. And if I'm wrong, I lose 1 unit, and if I'm right, I make 4 units. That kind of thing. The only time I did something more aggressive and position gold was when I thought it was in 2012 and 13 when I saw a bubble unwind coming at some point, and I just put on a position and hung on for dear life and hoped it happened.
You talked about gold dying off, and a lot of people are talking about the replacement to gold to be cryptocurrencies. I can't go a show without talking about crypto assets these days. No. What are your thoughts on cryptos?
I don't know. I'm not an expert on that stuff. From an economy standpoint, anything that incites that much innovation is probably going to end up being good for us in the aggregate, right? Even if these assets die off and become zeros. There's a lot of innovation going on that's going to be handed off to other products in the future, and I'm sure good will come of it, so that's good. Whether these things are the real deal, I have no idea. I don't. It's hard for me to think. You can't spend these things, and they're not a stable store of value. So before I can say it's arrived as a digital currency, I'm going to have to see a lot more. I wrote a couple posts. I wrote one back in December after I thought the fever had broken in Bitcoin, because there was a really, after Thanksgiving, it was like super feverish period, right? I'm sure you remember the Bitcoin was everything. It was going up 10% a day or 8% a day or something like that. And it was just a day after we were enabled to trade futures, right? At least I think it was the CME futures. And I got lucky. I saw a good asymmetric entry point around 18,700, and I shorted Bitcoin. And I've basically been short since, at least in price terms, continuously, right? So I think that's a bubble, and I think the fever has broken, and I think it goes lower, probably 8,000, 7,000, something like that. From there, I just don't know. But it's really based on technical analysis. One of the neat things about Bitcoin and some of the cryptocurrencies is you see the guys who are technically oriented on Twitter and stuff. All of them have been saying on the way up and the way down that crypto is following technical patterns to a T. And I thought about it. I said, that makes sense, because there are no fundamentals to speak of, not that anyone understands. And it's all about emotion, really high emotion. And that's what pattern recognition is all about. It's the expression of emotion in the patterns, picking up that expression. And if there are no fundamentals to contaminate it, then you're just going to get pure emotion. And that's why I think reading the charts has been so effective for people trading the cryptocurrencies.
Now, you grew up in emerging markets. That was what you focused on in the 90s. What are you interested in right now in emerging markets?
So for me, I look at emerging markets. I started out managing emerging markets debt, and then I went to emerging markets, a global macro hedge fund with an emerging orientation. So, and I've traveled to all these places in my policy years. I've been inside of, I don't know how many, dozens of central banks, right? More than dozens. So that's kind of my backyard. Two big considerations in emerging markets are, one, the cycle. When is it on? When is it off? And two, what degree of differentiation can we expect? I had been bearish emerging markets starting in 2012 when I saw silver go parabolic in 2011 and gold roll over. I said, commodities are deflating. This was in the middle of QE3, by the way. So the whole story, the QE, that was kind of the death knell for people who thought that the QEs were going to inflate things away. I knew when I saw gold and silver roll over that emerging markets were going to roll over too. They had been on a nice run, and in fact that happened. End of 2015, I started to get more constructive and put on positions primarily in emerging markets fixed income, which has really nice carry and appreciates with the currencies. It's kind of a nice thing. But that was really the beginning of the emerging market risk cycle, and I think it's going to persist for a number of years. Right. So yes, it's popular right now. Yes, it's run up since the beginning of the year, but longer term, I think the way it tends to work is people start by taking risk in the markets they know best, closest to home, because they're risk averse. So maybe they buy a few bonds, and maybe a few high yield bonds, and then maybe a couple utility stocks, and maybe then they buy some blue chip stocks, and then they buy some growth stocks, and then they start moving further out the risk spectrum. Well, at this point in the risks in the risk cycle, people are saying, okay, valuations are full at home in the U.S. Let's go abroad for returns, and they start reaching. This is why the dollar tends to depreciate at this phase of the cycle. People keep looking for the dollar to go up because rates are going up. They miss the point that investors are fleeing the United States, not because they're afraid, but because they're greedy. Their greed can be better satisfied elsewhere, right? Because we're in the greedy phase of things. We're not at the end of it, perhaps, but we're closer to greed than we are to fear now, and people are reaching in other markets. So the emerging market cycle has a long way to go, I think, and it's still quite attractive. And counterintuitively, though the U.S. is raising rates, it creates a backdrop offer for the dollar that is pressures for it to depreciate. So people, it seems like there are only two modes in the dollar. Dollar's going up and it's going to crush all the emerging markets and then turn the gun on itself and everything's going to implode, or the dollar's going down, they're debasing it irresponsibly, inflation is going to come, watch out for, don't worry about commodities inflation. The pass-through is very low. Yes, it correlates to our inflation, but only a little bit of it ever comes through. We saw this And we had massive commodity cycles over the past 10 years, and we never had inflation get out of control. So people shouldn't fear that again. But it just seems like people see the dollar move and they gravitate to one crisis or another crisis, depending on the direction. I think both are wrong. The dollar should, there's a headwind in front of the dollar, and that's at this part of the risk cycle people are allocating to foreign markets. It's really that simple. Emerging markets should be a little bit more differentiated this cycle than they have in previous cycles, because you have some places, Turkey has some real problems. Venezuela doesn't even really exist. It's not part of the index, but things are a little more asynchronous across the emerging market world. So it won't be as dramatically lockstep as the rallies that we saw in emerging market cycles previous. But it's also not going to be, a lot of guys got hurt in 2016. John Burbank and his passport fund, they closed down. A lot of guys had this thesis about a king dollar, shortage of dollars, it's going to crush emerging markets. Basically, they were waiting for the old school emerging market blow up where people are forced to sell their positions in the street and then so they could swoop in and buy. But those days are gone. Emerging markets are more of a legitimate asset class, and they're not allowed to fall nearly as far as they did in the past. Not just because we look at those the asset class differently than we used to, but much more importantly, in Brazil, in Korea, in Turkey, in Mexico, all of these guys have much deeper domestic financial markets. They have insurance companies now. They have credit markets, right? They have mortgages. They have asset managers. So there's a home bid for these things in a way that wasn't there 15 years ago. 15 years ago is Mohamed Al-Arian buying or selling? That's all you needed to know, right? Is PIMCO buying or selling? That world is kind of gone. And the people that were expecting that to come back in 2016 got seriously hurt. So the emerging market cycle from here, I expect it to be long. And I expect there to be a little bit more differentiation across countries because of what we're seeing out there and how the domestic financial markets have developed in a lot of these emerging market countries.
Fantastic insight today, Mark. I can't wait to go back and listen to this episode myself, but we're not done yet. We have some rapid fire segment questions if you're ready for those.
I'm ready.
All right, everyone. Our rapid fire segment is sponsored by Trading Technologies. Trade the global markets from virtually anywhere with TT. They are the world's fastest commercially available futures trading platform. Create your account and try it now, free at tryttnow.com. Mark, first question. What trader has influenced your life the most and why?
Well, I don't want to name him, but he was a colleague of mine, and he cut through noise better than any human being I've ever seen. So coming from a hardcore fundamental background like I did, it was really hard to get the right balance, strike the right balance between fundamentals and just animal spirits, market sentiment, and all these kinds of things. And your tendency is to get lost in the third level of detail on the Brazilian budget deficit, and usually that's not the driver. This guy, better than anybody else, could cut through, and also he was really good with options. So I learned how to manage options in kind of complicated markets. So that I don't want to name him because he probably doesn't want the publicity, but he's a really, really good trader, and he gets to the bottom line better and quicker than anybody I know.
How has your trading evolved over the years?
My trading, even though I was always skeptical of efficient markets, even when I started, I became much, much, much more skeptical of them. I think the markets just aren't efficient. Remember when people 10 years ago when both Democrats and Republicans were saying, oh, the banks are smart and they have every incentive to get it right, so they can be trusted to regulate themselves. Well, guess what? They're human too, right? And they got us into a big mess, taking a lot of aggressive risk. And of course, we took homeowners took a lot of aggressive risk at the same time, right? So I've gotten much better at figuring out when the fundamentals matter and when they don't. That's really it. It's really, really hard for a guy with a fundamental background. It's almost a disadvantage to have a fundamental background if you can't harness it right. It's almost like being a smart guy. Smart guys get themselves into bigger trouble in the markets often because they're more prone to overconfidence. The fundamentalist says, I just know this is wrong and I'm going to short it, and that was 400 points ago in the S&P or whatever, right? So I've gotten much, much better at figuring out when and how to incorporate the fundamentals into my investing and trading.
What's the number one resource you spend your time on?
Um, I use Twitter. I get a lot of information on Twitter just for sentiment purposes, and I watch the financial news, Bloomberg or CNBC. So I use that a lot. Apart from my own systems, I'm on those things all the time, listening and trying to figure out what the story is that the markets currently believe, and how strong is that belief, and is that belief waxing or is it waning? And then do I share that belief? Those are the questions I'm always asking myself. All the news gets filtered through that prism.
What's your favorite book about trading or the markets?
I love the book Jesse Livermore's Reminiscence of a Stock Operator. It's really fun, but probably the most helpful thing is I should say for pattern recognition stuff and technical analysis, Stan Weinstein, How to Profit in Bull or Bear Markets is one of the first ones I read, and it looks like a cheesy book from the 70s, but it's really good. It's really helpful, particularly if you're an economist and didn't grow up in markets, you came to markets later. It's really helpful. And then the last one I would say is Daniel Kahneman's Thinking Fast and Slow. You just realize how stupid we are. Not really stupid, how easy it is for us to succumb to our own emotions, however rational we think we're being. The example after example after example he gives in his book is just, you think, wow, I shouldn't even be allowed to drive a car. Humans shouldn't even be allowed to drive cars. It's just amazing. So it's very humbling for people who think they're right and have a lot of confidence. This book puts you in your place.
What's your favorite movie or TV show about trading or the markets?
I'm a Trading Places guy. I love that movie, right? I just love it. So there's nothing. That's part of my generation, but I think it's the best one. Although in the recent wave of movies about the financial crisis, The Big Short was by far the most accurate. Some of them were quite tendentious and had political points of view. I thought, as a guy who was in the middle of all this stuff, an ex-policy guy who was in the middle of the financial crisis as a market participant, The Big Short was by far the most accurate.
What is the best piece of advice that you've received about trading or the markets? I
got it from a Merrill Lynch salesman. He said with a Boston accent, he goes, "Mac, don't get caught in the weeds." He was saying, "I know you're a smart economist, but don't focus on what's driving everybody else in the market, not what you think matters." And that was very, very helpful to me.
Now, if you can give a piece of advice to the new people interested in getting involved in trading, what would it be?
Risk management is more important than having good ideas. You can survive on risk management alone if you're good at it. If you have, obviously, the ideal is to have good risk management with superior ideas. But you can survive on risk management alone. You cannot survive on good ideas alone. You will go bankrupt, almost for sure. Because if you liked it at 50, you have to like it at 30, and then you end up having a position that's way too large and it kills you. Can't come back from it.
Last question for today. If you weren't involved with markets, you'd be doing what?
I would be teaching either economics or finance or something like that, or I'd be a dog trainer. I always grew up with a lot of animals. We even had a monkey at one point. My cousin had a pet lion. We all kind of crazy animal family, but we always had cats and dogs. And dogs are just they're just great. Training a dog gives you a lot of satisfaction, and the dogs need it and love it. So the love that they give you when you train them it's a beautiful thing.
I could spend all day with my dog.
I know.
It's all I want to do, really. Where can people find you on social media, and give us a website to check out?
Okay, so Behavioural Macro is the website. Some of the posts, behavioralmacro.com. Some of the posts are locked. The older ones aren't, so go in the archive. Some of the old fundamental ones are the ones that kind of the fundaments for my whole philosophy. They're there and accessible by anyone. And then I have my premium Twitter feed, if you want to call it that. That's Behavioural Macro. And then I have my regular Twitter, which is Mark_Dow.
Obviously, everyone, after listening to Mark today, you have to go and check out him on Twitter and go to his blog. It's fantastic. I read his blog all the time and his tweets. And if you have a tweet deck, I always keep Mark up just to see what he's looking at and thinking about markets. Mark, thank you so much for coming on Futures Radio Show.
Thanks, Anthony. I appreciate you having me, and I'm glad we got it to work out after all those time.
Yeah, no, absolutely, Mark. I really appreciate it, and I look forward to having more conversations with you in the future.
Absolutely.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.